Chris, it's the Pilgrim's Progress. This year I made it to Chicago. Next year I'll make it to London, Ontario. So that's the good news. So I'm sorry. Well, I'm not sorry, actually. I actually think that what often happens with PowerPoint presentations is that they get between who the person really is and the audience. So what I have for you here is some prepared thoughts, which will take me probably about 20 minutes to get through, and then we can make this interactive. And so one of the I've been discovering some great benefits of writing a book. For example, one of the great benefits is I get to hang out with you fine people, which is really, really wonderful. I mean, it's stimulating and valuable and interesting. But another thing that it does, and there are many drawbacks actually, especially from an investment standpoint that I'll get into, is that it freezes me at a moment in time. So that book represents where my thinking was almost, end of 2014. So, a year and a half ago now. And then what's sort of people know me from there. And then, but I've moved on. And so managing that is interesting. So, and I guess, so here's what I want to suggest to you. And there's a theme that has been in my mind a lot. I think it's knowledge that I've gained subsequent to the book. So the book, in many ways, when I read my book, when I go into the second part of the book, there's much there that I feel is facile or sort of well, I wouldn't say limited value. It's still valuable, but it kind of, it gets 5% of the way there rather than 100% or even 50% of the way there. And it's interesting, Monish Pabrai, who I think will be talking to you guys later, sent a copy of the book to Charlie Munger, and I got the best compliment I think I could possibly get out of him, which through Monish, where he said, Charlie Munger said, well, Guy Spier more or less gets it. Which I was happy with, but I think the fact that he said more or less, meaning he's not quite there, means that there are some really important things that are lacking. And here's the idea that I want to share with you. And so for as long as we've had an economic system of prices and money and markets, humanity has had fluctuations in those markets. Well before the great crash of 1929, there were great manias and great crashes in all sorts of different markets. And it just seems to me that the way the interaction between human minds, the physical aspects of what a market is made up of, and prices results in these extremes where you go from boom to bust to boom to bust, and these things keep reappearing in a kind of a complex dynamic way that we can't quite predict, and it just seems to be with us, and it can create billionaires out of people, as it does in dot-com booms and similar, and during the tulipomania, but it also wipes people out. And people get wiped out in the 29 crash, and people got wiped out in 2008 and have to start again. And then we get people like Bernie Sanders that come along, who sort of promises to get rid of this is perceived to be very evil by many people, and probably rightfully so. They have a great misgivings about those of us who either work in or want to work in marketplaces of one kind or another, because they see these huge fluctuations and they say, what does this serve anyone? And so what I'd put to you is that in a certain way, the history of the last at least 100 years, probably more, of economic policy making, and then I'll take it to an investing, has been the history of us as a species, as a civilization, learning how to handle those fluctuations. So if we think of the Great Depression, part of what Ben Bernanke studied was how the Federal Reserve System at the time, by being unwilling to act to accommodate what was going on, actually made that crash of 1929 worse, much, much worse than it had to be. And we got after that Franklin Delano Roosevelt and Keynesian economics, where John Maynard Keynes. There's sort of one of the most important things that the ideas that John Maynard Keynes introduced was this idea that the government acts as a stabilizer. Government spending acts as a stabilizer. So in a time when the animal spirits of the economic system result in low activity, the government is there spending money, and the government is there stabilizing that. And when you think of government payments, transfer payments to the unemployed or to the military, or all sorts of things that the government does, those stabilize and become a larger proportion of GDP in an economic downturn. And that, in a certain way, is a kind of a natural stabilizer that we've now accepted is a normal part of our capitalist system, to have that in the United States and pretty much every other Western European country. And that means that the fluctuations are not so great. And we have other institutions that do that. So if we think of the crisis of 2008, Ben Bernanke had to do a lot of convincing, along with Hank Paulson, of various people, but they got it through. They said, we have to increase the supply of money massively. There's cascading contractions of credit taking place as financial institutions stop trusting each other. We are lenders of last resort. We have to make this money available. It's not a question, and they did. And with these massive bailouts of Freddie and Fannie and of the automobile industry. So, and we all know, and Warren Buffett and others have said many times, if we had not had those people taking those policy decisions, we would have had, the fluctuation on the downside would have been far, 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 far worse. So, just a couple of other things that are sort of counter-cyclical, things like, well, the Federal Reserve being the lender of last resort, which is just a given. It's just nobody doubts that that's the case, and nobody wants it to change. Or the Federal Deposit Insurance Company. I mean, when we think about the fact that there's been very, very few runs on banks in at least the last 50 years, probably more, but runs on banks were just a feature of our economy, of our Western style of capitalism, and we've managed to nail that. So we're improving as capitalists. So how does this apply to investing, and why does it relate to investing? Well, I think it relates in this way, in that actually, so I'm thinking a lot about things that are pro-cyclical, things that exacerbate the business cycle, and things that counter it. So I've just given you 3 or 4 examples of policy and institutions that are replicated across developed democracy, capitalist democracies that act as stabilizers. But I'll give you a few that we haven't managed to stabilize yet. So one is, interestingly enough, the system of credit ratings and the system that we have of bank capital. So part of what the Federal Reserve had to counter in the last financial, the crisis of 2008, was that banks were pulling in loans, and they were kind of de-risking their balance sheets at exactly a time when ideally you'd want them to risk up. You'd want them to be lending more money. You'd want them to be getting business going again. And so the Federal Reserve took some of that weight, but in a certain way, it cannot. The money needs to be made available on a retail level by the banking system. But the banks are saying, well, we've got Basel III coming along. We've got the ratings agencies have become a lot more conservative. So it seems to me that the sort of the view of banking reserves and the view of ratings agencies is pro-cyclical. Another aspect of that pro-cyclicality is the way, in the run-up to 2008, ratings agencies were willing to give all sorts of crappy CDOs and CMOs AAA ratings when they shouldn't have done that. So we haven't figured that one out. I would give you another sort of like pro-cyclical force, I think, that has emerged is in the last 4 or 5 years is China. So, I think that it's sort of like a truism that the Chinese, the bureaucrats in China who are responsible for reporting growth fudge the numbers in a massive way, such that nobody trusts the numbers of what China's growth is. Was it 10% in the past? Is it 5% now? We don't really know. It's quite likely that it wasn't as high as they were reporting it to be in the past. And they still may be reporting higher growth numbers than China actually has. And, reporting higher growth numbers is a kind of a pro-cyclical thing to do. It generates more inflow of investment dollars and more animal spirits than it should. And I think that it's part of a maturing of an economic system where the people who run it start to understand that their job is to be, in a certain way, counter-cyclical. And China is probably 50 years away from that. And part of the instability that we're experiencing right now is because China is such a big economy, but it's in a certain way, in terms of its economic management, very, very immature. So that sort of is those waves are being felt around the world. Then we get, people like Ben Graham in the aftermath of 1929, and he figures out that he can go and hold a Geiger counter over stocks and buy things for the less than the liquidated value. And he could just buy these things and potentially even liquidate them and make money out of the liquidation, let alone as a going concern. That was a kind of on an individual, on a fund level, a sort of the first time that somebody was coming along with, actually from the investment standpoint, this is from the private sector, a counter-cyclical approach. Something where, if you have enough participants who think about that, who think about the world in that way, you're actually catching asset prices and they don't fall as much, and the disruption that arises because of the falling asset prices is not as great. And I think that we've reached a place today where, everybody's a value investor. Many people understand how to value companies. They understand the concept of buying for less than the intrinsic value. And that is a great thing. It's not great for people who want to be investors because it means that the competition is enormously greater. But it actually makes a massive contribution to the good functioning of asset prices and the good functioning of asset markets. And to have players like Berkshire Hathaway there that can buy in all circumstances, or even, the vast mass of the Guy Spiers and the Monish Pabrais and the others of the world who are able to do it a little bit better, is actually good for the capital markets, and it's good for liquidity and all sorts of things. So, but then if we come down to my sort of micro level, I think that much of what, and this ties into the book and investing. So, I describe moving to Zurich as a way of getting out of the noise. Another way of describing the noise is that it's pro-cyclical. It gets you to do stuff that other people are doing. So I'll just stand back, and now I'm not talking about the grand things like macroeconomic policy and how governments are set up. I'm just going to talk from my perspective a little bit. What I've seen, having lived now through 2 or 3 market downturns and at least 2 or 3 upturns, is that the subjective feeling that you have in an upturn is, oh, damn, there are all these people who are making more money than I am, and they're making money faster than I am, and I must be stupid. And so all of those feelings, which are very subtle, I mean, it's not like they kind of come with a great big announcement into your brain and say, I'm one of these feelings that's generated by a market upturn. They kind of find their way into your consciousness, and they disguise themselves in all sorts of ways. But they tend to lead to pro-cyclical behavior. They will lead to people taking more risk for a turn. And I would even argue that in the case of sort of dyed-in-the-wool value investors, potentially it results. So a guy like me isn't going to go and buy Uber or Airbnb at a zillion times earnings. It's because I've kind of trained myself not to do that, or other darlings. But it may be that I take on risks that are more subtle, but they're still risks. And I think of what we've seen. If I go to recent history, it's sort of, some things have really shocked me. So I'm a big fan of Bill Ackman's. I think he's a brilliant guy. I think that he's one of the world's great investors, but he seems to have been hit really, really badly by having such a large proportion of his assets in Valiant. And it's not just Bill Ackman. Ruane Conniff, and for me, Ruane Conniff, just naming the name is hallowed ground. There's this guy, Bill Ruane, and Richard Conniff. These two guys were friends of Warren Buffett's. And Warren Buffett, when he shut down his partnership, it was the only firm that he recommended his former partners to invest their money with. They had a huge position in Valiant. And, so what do I see in Valiant? Bill Ackman and Ruane Conniff and a number of other people convinced themselves through subtle means that this was a better business. And in many ways, you could argue that it was a better business, but the way they did it, the way they were earning these super high returns had flaws to it, flaws that became all too apparent last year. And in a certain way, even though I would argue that even though Bill and Ruane Conniff were not consciously doing it, they were acting in a pro-cyclical way. And I can see much of my behavior and my very bad returns I've had over the last 18 months that is the result of pro-cyclical behavior creeping into my world. And if I stand back and ask myself, why did that happen in my case, or in the case, it's better to ask for my case than in Bill Ackman's case. This is where I think my thinking has moved on from the book, and I'll be done in about 5 more minutes. So start thinking about the questions that you have. But I talk about in the book about these things like not checking the stock price every day and not switching on the Bloomberg monitor. And if I buy something that goes down, don't sell it for 2 years. And those are all true, and they're all good things to do. And those are all sort of behavioral ways. So we go from the grand macro, the sort of Keynesian government stimulus, and the way that the government taxation and spending acts as a stabilizer in economic downturns, all the way down to the micro, which is Mr. Guy Spier's individual behavior. That's all good, but there are some things. There's some really important things that I missed out in that if I was writing the book now, I would write in, and I'll just give you a short laundry list of a few of them, which is, well, before I do that, I'll just do one other thing. In a certain way, the world, just going back to macro policy for a second, we're really good at dealing with downturns. We're really good with recognizing them. We're really good at knowing what to do with them. So on the macro scale, Alan Greenspan, Asian crisis, 1998, 1999, knows that he's got to give a stimulus, or after 2001 or after 2008. We're good at that. And as value investors, we know that when prices go into the ground, when there's fear in the streets, we have to buy stuff. I throw up during those times, but I still have the wherewithal to know that I need to do that. But it seems that we're not very good at dealing with the irrational exuberance side. We don't know how to moderate that. And that irrational exuberance, I think, can lead, the housing bubble was something that would have been great if we knew how to moderate that and how to prevent such bubbles from happening, or the dot-com boom of 1999, 2000, or what I think is, or the Nifty 50 in the 70s, or it's just not good for anyone to have too crazy prices. And then if you come down to me, I think that I realize that there's a lot about my behavior in the last 2 or 3 years that is similar to the behavior that I had in the run-up to 2008. But I didn't recognize that. I didn't see that. Again, I don't have a problem managing myself in a certain way in the downturns. But in the upturns, I kind of said to myself, this is normal, whereas actually it was not normal. We were going through a period of exuberance, and I would have been good to de-risk my portfolio in all sorts of ways. And so so there's a whole sort of side to me that I think I need to develop, which is this sort of like my own, in terms of the macroeconomy, I don't know how to prick bubbles in a gentle way, which is what we want. In my case, I know that going into another period of exuberance, I just have to ask myself, are people scared, or are they greedy? And if people are greedy, I have to be determined to accept on a very profound level that people will be getting rich faster than me. And I have to force myself to de-risk my portfolio. De-risking my portfolio means to become more diversified, to increase cash levels, and to move and to move into areas which I know are de-risked, I guess, or lower risk. And and so this is where, again, there's no lesson that I've learned that I don't realize as I'm learning it that Warren Buffett already knew it. And in terms of this, so Freddie Mac and Fannie Mae are now in government conservatorship. They're these drones that are kind of like part of the U.S. government, effectively, and will never be released into the wild again. But for a long period of time, I think about 15 years, Berkshire Hathaway had huge positions in both Freddie Mac and Fannie Mae, and they were considered to be sort of like better businesses that everybody should be invested in. And in 2008, a number of storied and brilliant value investors, Bill Miller, I think, was one, Fairholme Capital Management was another, Pazina, the guy who's the protege of the guy who wrote the book that beats the market. All of those guys bought Freddie and Fannie, saying these things could never go bust. And in late 2008, those things were taken into government conservatorship. But Warren Buffett, in 2004 or 5, sold out completely of all his positions of Freddie and Fannie. He had noticed that the accounting was becoming less tight, and he was able and willing to forego all of the upside. And from the time that Warren Buffett sold, those stocks would likely have tripled. And he was able to forego all of that and not feel bad about other people making more money than he was making, and to have missed the tripling of those stocks that he had sold out of his portfolio. It's only sort of like 4 or 5 years after he sold them out of his portfolio that you see that he dodged a huge bullet by doing that. The discipline to be able to do that is, or whatever it is that enables you to do that, is just enormous. It's just, in a certain way, it's another Mount Everest for me. It's a kind of an unapproachable thing. I can't imagine. I know that I want to be able to do it, but I actually, I don't trust myself to be able to do it another time around. And so what my plan is, and forgive me, I don't know if you can hear this. There's some kind of announcement happening outside this conference room. But so the way I would not rewrite but add to the last chapters of the book is, so great, you separate your library from your workroom. You switch off the Bloomberg monitor. You don't check your prices. But here's something. This sounds crazy, but what's your relationship to your wife? So I think that in a period of exuberance, I've actually sat and started talking to my wife about what a period of it, and she's a homemaker, and she studied communication science. She used to work in advertising. But I realized that, are the close relationships in my life pro or counter-cyclical? Do they see me all excited because my stocks are up, and then they decide that they want to egg me on, and that actually the neighbors are doing better and I should be investing more aggressively? Or are they going to do the opposite and say, wow, if things are that good, it's probably time to take money off the table? And I've just gently taken my wife through that, and a bit of what I've been telling you right now, so that she understands how she can help me to be counter-cyclical. I have also instituted a kind of a mid-flight checklist. So there are things on the mid-flight checklist, not a checklist that I run before purchasing the stocks, but while the stocks are in my portfolio, that is run by somebody else in my organization who can come at me and say, have you noticed these things? And again, it's not fail-safe, but I'm trying to create the opportunities for me to reevaluate when things have gone up a lot and life feels good. And so what I would tell you is that, to me, at this moment right now, this idea of the distinction between what pro-cyclical versus counter-cyclical, we're looking for a world, we're looking to build a world on to the extent that we're actually doing a public service, we're looking to build a world that is counter-cyclical. We're looking to build a world where these natural fluctuations that we see, that we're trying to moderate them and dampen them. I don't know. You must have all seen pictures of bridges that were badly designed, where you have the wind blowing and then the bridge collapses because there's some kind of resonant frequency, and the bridge wasn't dampened properly. Well, that was our economy 100 years ago, and we've gotten better at it, but we still need to get a lot better. And then, as an investor, it's not intelligence or ability to analyze companies that's going to make me into a better investor. It's the ability to, in a certain way, to dampen my own swings, to dampen my own moves to exuberance. So just to sort of round out that point, I went into this current economic turmoil with a portfolio that was more concentrated than I would have liked. And I was telling my wife that that's exactly what happened in 2007. I realized I was more concentrated than I ought to have been. Something that you get at the end of an upswing is people become more and more confident about the positions that they own, and they double down on them, and they buy more of them, and they don't diversify and think more broadly. And that's not something that happens consciously, it happens subconsciously. So how do I set in place the ways in which I'll prevent myself from doing that during the next upswing? And how do I set up my life in a more counter-cyclical way? I think I'm still learning, and there's a lot of work that I can do. But with that, I don't know if I've been clear. I probably could have put all of this onto slides, but I'll just jump back. Maybe I'll leave you with this last quote that goes all the way back to the Bible. It's the famous King Solomon, who had on a ring, I think it was, "This too shall pass." And, the good times will pass and the bad times will pass. And, this idea that is very useful when we're investing in crises. The world, this is Howard Marks, who said the world usually doesn't come to an end, which is fine on the downside. But actually, like I said, the upside is a lot more difficult to manage. And if we want to become great investors, that's kind of where, if I want to become a better investor, which I certainly do, that's where the rubber hits the road for me, managing myself through an upswing. And with that, I will stop. I don't know how long I went for, but I will stop, and hopefully you guys have some great questions, interactivity that we can do.
Thank you very much, Guy. Appreciate your comments. And I'm going to ask now my students to come down here on the mic and ask questions. You sent me a few copies of your book, which I'm going to pass around to my students later on. So don't be shy, come down. In the meantime, I guess, can you just comment on what is the biggest mistake a novice investor makes?
The biggest mistake what?
A novice investor makes. And what's the biggest mistake you made?
The biggest mistake I've made is out there for everybody to see right now. I had a substantial part of my portfolio in this company, Horsehead Holdings. I never thought, George, I thought I'd get through my investing life without being invested in a company that actually would go bankrupt. And I have now woke up in January of this year to discover that I'm actually invested in a company that filed for Chapter 11, and the mistakes were subtle. It's not that it's not a fantastic business. Ultimately, it will be a fantastic business, but it was funded all wrong. There are a number of sort of things that came together to make it a huge mistake, and a very visible mistake in my portfolio. George, I hope that by telling you this, I will never make such a big mistake again. But that is certainly my biggest mistake, and there are so many rich lessons from it that I'm writing up in my annual letter. Each one is a juicy, worthwhile lesson, and each one of them is so unbelievably painful for me. Very expensive learning experience for me. So,
thanks, guys.
Mr. Spiers, excuse me. Thank you very much for your valiant effort today to try to make it out to London. I know the weather is brutal, but very much appreciate your presentation today. I wanted to say I really enjoyed your presentation as per as you had mentioned, with respect to a lot of the Basel reforms and with respect to the ratings agencies. And I guess more or less my question is along the scope of understanding what your thoughts are on the intermingling of all of these agencies in conjunction to the banks, and what your thoughts are on the, I guess, what was proposed as a reinstation or to reinstate the Glass-Steagall Act. What your thoughts were on that post the financial crisis?
I mean, so here's the problem that we have. So it's funny because I just see parallels between the management on the macro level and the management, let's say, of my portfolio. So anybody who goes into a period of market turbulence wishes that they had more cash, because with cash you can put it to work and it gives you strength and flexibility. But you go into the period of market turbulence with the cash that you have, not the cash that you wish that you had. So if you were fully invested, you just have to ride it out. And if you were not fully invested, then you can put the cash to work that you had, which even though it wasn't as much as you wanted, you put it to work. But you can't say, oh, now the market's turbulent, now my portfolio's down, so now I'm going to raise cash, because that's the opposite of what you want to do. And I see the same pattern in bank capital ratios. So yes, the period leading up to the financial crisis had banks and investment banks too leveraged. But then, immediately as you go into the crisis, that is exactly the wrong time to increase their capital ratios. Yes, you want to do it, but you want to wait until the crisis is over. And so conversations with banks a year or two or three ago, where they're saying, yeah, on the one hand, the central banks want us to lend all this money out and stimulate the economy. On the other hand, we're dealing with Basel III ratios and credit rating agencies who've become a lot more conservative. It's slamming the barn door shut after the animals have fled. And it's just not easy, because I think that the policymakers, what they would say is, they'd say, yeah, Guy, you're absolutely right. It is the wrong time to be closing the barn door, but we have to close it now because we'll never be able to close it any other time. So yes, we just have to put these capital ratios in now, and it'll be painful for 5 years, but we'll never do it if we wait 5 years, which would be the ideal. But that's a whole political lifetime away. And the glass. It's interesting. Excuse me.
Bless you.
The Glass-Steagall Act was put in place just after 1929, and now they're talking about bringing it back. And the last vestiges of the Glass-Steagall Act, I think, were removed sometime in the 5 or 6 years before the crisis of 2008. So again, that was countercyclical, and I would argue that we're on the verge of a sort of a 30-year-long, a 3-decade-long expansion of credit from the banking system that will start any time in the next year or two, which will start when sort of like Basel III and reform of the banking system and making the banking system safe, when it's run its course. And then it will go, and then 30 years' time, which is, all of us will be retired, we'll probably have a financial crisis again. So,
yeah, I guess to that point specifically is that you mentioned the over leveraging and considering that right now banks are actually more leveraged than they ever were prior to 2007, 2008. If you look at the loan leverage index, I believe it's LTSA, and it's just more or less interesting to see how, I guess, respectively speaking, it's like how loose it's become, especially like Basel III reform has been extended over since 2013, and these extensions are looking till 2019. What do you find to be, I guess, might take a lot of time. Just that my quick question would be, what are your thoughts on, remaining or keeping it voluntary in that respect?
I actually think so. I've done a little bit of work in Switzerland. I can't talk to the United States. I tell you, the United States is the banking industry is becoming more consolidated. That's just the way it's going. But there's very strong arguments for saying that no bank should have a $2 trillion balance sheet. And there's an especially strong argument in Switzerland for saying that banks shouldn't have a $2 trillion balance sheet, that you just basically shouldn't allow banks to get too big to fail, and that the larger banks in Switzerland and perhaps in the United States should break themselves up. It just becomes very hard for policymakers to make that happen.
Absolutely.
So, yeah, but I feel like I went to business school not because I wanted to become, I talk about the Gordon Gekko aspect of my personality. I wanted to make money. It's true. And I just think that we in the financial industry, and I expect that many of the people sitting in the room with you and effectively with me will go into the financial industry. We're really hated by a lot of people. We're hated by all the people who are going to vote for Trump, and we're hated by all the people who are going to vote for Bernie Sanders. They really do think that we're the incarnation of all evil, and that it's part of the reason why Thomas Piketty's book has had so much success. And I didn't do anything wrong in the financial crisis. I didn't cause it, but I'm part of that same industry, and we in that industry have to earn back the public's trust. We have an extraordinarily easy life, and we need to earn that. And we've done a lot of disservice in terms. Well, we collectively have done a lot of disservice by causing fluctuations which probably didn't have to happen. It's not like one individual is responsible, but I think that just learning what creates pro-cyclical behavior, what exacerbates the cycle, what dampens the cycle, and trying to make money for ourselves, which is our right to do so, at least in the capitalist democracies where we live, but with an eye to the moral aspect of what we're doing, with an eye to trying to allow for, increase the probability that counter-cyclical institutions and attitudes and measures exist so that business fluctuations are dampened, I think is a good thing. And so there's a moral aspect to what we do which should not be forgotten, I guess.
No, absolutely. It's definitely an uphill battle. Thank you so much for your insights.
Yeah,
today.
great to meet you. Thank you.
Hi, how are you? So you spoke about how a lot of the times it's the subconscious influences that can cause irrational behavior. And I know you mentioned that you have a checklist that helps you keep in place. But how do you realize, or how would you go about controlling some of those subconscious influences when you don't even know they're kind of seeping into your behavior?
So here's part of what I've learned and realized is, again, I talk in the book about how I'm not Warren Buffett. Well, yeah, that's true. But then why did I set up many aspects of my environment to be like Warren Buffett? In the group of students that I met, I talked to 4 students for a publication beforehand. I was talking about how it's really, really important to when we model somebody, we have to model the right parts of them. I could model. I think the example I took is so. Forgive me for the salacious example, but Madonna slept around a lot when she was active as a pop star, but she also worked damn hard. So those are this is like very sort of cartoon cutout-ish type of distinction. But I can choose to model her sexual behavior. I can choose to model how hard she worked, and one will lead me to good results and one won't. And so, I need to model Warren Buffett in a way that is consistent with the understanding that Warren Buffett is very, very different, both in terms of ability and personality to me. And I can easily draw the wrong lessons by modeling the wrong things. So I think that by his makeup, there are just things, it seems, I don't know what it is, but he, like I talked about, the ability to sell Fannie Mae and Freddie Mac years before the proverbial what hit the fan is just something that I don't know that I will ever be capable of. But the checklist is a great idea, really good. But so here's some really important things that are missing, and it blows me away that Monish and I missed it. In flying, You don't have a pre-takeoff checklist. You have an in-flight checklist as well. But I didn't apply a, quote, in-flight checklist or a sort of during the investment. So if we talk about my disaster in Horsehead, I did not monitor the buildup of leverage. If I'd have looked at that investment as a new position in my portfolio, it wouldn't have made it past the leverage screens and the checklist. But because it was already in the portfolio, I wasn't really asking myself that question seriously. And so I now have a member of my team who's his role is risk manager, and his role is to run an in-flight checklist on a regular basis across all the positions to ask what is going on, what changes have taken place, and if changes have taken place, I need to write up the reason why it's still okay to be in the portfolio or what changes in monitoring I have to have. But I think your question is a great one, and I think in a certain way the question contains within it the seeds of the answer, which is once you identify the subconscious ways in which things seep in, you can start figuring out how to handle it. So, the competition for status that occurs in places like New York City, the answer might be to move away or to develop a social circle that's very different to the ones who compete for status. So I think that the question, but there are many and subtle things that one needs to do. There's no question about that. I'll give you one again, which is kind of an update from my book. I find it really interesting that Seth Klarman. So Seth Klarman writes this book, Margin of Safety, fantastic book. Strongly recommend you get a copy. There's copies floating around the internet, so you don't have to buy the super expensive copy off eBay at $2,000. But I haven't asked him, and I don't know him. I have met him once personally, but I think he's the guy buying those books. That's the price is so high because he wants every copy of that book out of circulation. And the reason why he wants it out of circulation is that it's become clear to me that you have to decide, do you want to be a commentator? Do you want to be a journalist? Do you want to be somebody whose opinions are listened to? Or do you want to be a good investor? The two are completely different. The one is you take a position that is not necessarily popular, that is against the crowd, and then you research it well, and you figure out what you believe the reality is, what your variant perception is, and you stick with it, and you act on it, and you bet, or you invest money based on that variant perception. When you're in the world of selling books, getting yourself onto TV, into newspapers, you're selling your ideas. You need to make your ideas popular. You want people to read it. You're running after the opportunity to get on TV shows, to have journalists listen to you. They're two fundamentally opposed things. I don't think that you can be a good investor and a good journalist or author, or you just have to decide. And in a certain way, once that distinction is made, it becomes easy to say no to certain things. And for example, for me to say, I don't think I'm going to write another book. So I don't think that you can. So you can't walk around and say, how do I guard against unconscious things? But I think that once you identify specific things that can creep in unconsciously, it's pretty straightforward to know what to do about it. And I think the answer already lies in the question. So, but I don't have all the answers. And Warren Buffett, I'll tell you what Warren Buffett would say. He'd just look at you and say, I don't know. But he's doing it so much better than the rest of us, which is just, he's sui generis. He's out there,
Thank you.
Yeah.
Hi, Mr. Spiers.
Good to meet you.
Just looking back at recent history, one might say that the first half of 2009 was the best time to buy equities in terms of all-time low valuations. So I just want to know what went in your mind during the first half of 2009. Did you buy stocks at that time? If you did buy, what was the thing which gave you the courage to buy?
So, and it's nice to meet a fellow Indian. You know that at heart I'm Indian. Did you know that?
Nice to know.
I'm convinced if there's such a thing as reincarnation and past lives, I'm sure that in a past life I was Indian, because I just have this. I feel that. I'm sorry, I just have to tell you this. My wife, she's Mexican, but she secretly admitted to me that she likes Indian food better than Mexican food. Indian food is better. There's more variety. There's just more variety of spices. It's like, anyway, but if you ever need good food, you just have to fly down to Mexico and you'll get some really good spicy food, nowhere near as good as India. But, so I was throwing up over every stock that I bought in 2009. It was very, very hard for me. But there was a number of stocks that were unbelievably cheap. And they were very easy to see that they were cheap. I mean, they were literally nets or trading for a discount to the cash when they still had businesses. So did I buy as much as I would have liked? No. And I also sold some businesses, which I wish I hadn't sold. I sold, actually in the run up to the financial crisis, I sold Crisil, the Indian credit rating company. And I sold, after the financial crisis, I sold Moody's, which I really wish I hadn't sold. I was really worried that they would get litigated and their balance sheet would be destroyed by the litigation. It turned out not to be the case at all. But I mean, one of the stocks I bought, I remember, was a company called London Mining. London Mining had like $300 million in cash and was trading at like a $200 million market capitalization, and it had these projects in Saudi Arabia and Greenland. I mean, crazy places, but they had great projects going on, and there was a strong price of iron ore, or the iron ore price had not declined by that much. I'm trying to think what else I bought. So I did buy some things, but how did I feel? I was throwing up all over every purchase that I made. I knew I had to be buying, and it was really hard for me to do it. And but what? Like I said to you, I don't think that is my. If I can improve as an investor, it's not going to be because I buy better. It's because I become less exuberant and identify the ways in which I can become exuberant, and I prevent myself from doing that. And I set up structures and ways in which. I actually, when we go through market turmoil like we're going through right now, I've coached my wife to tell me, what you could do is when I come home from work, I've told my wife, you could say, did you buy a good stock today? Just to help me think in that way. And really to coach my wife to tell me when there's exuberance, wow, people are making money fast. Maybe it's time to pull in our haunches a little bit. So.
Just to follow up, even in the present times, if your portfolio did fall by 20%, like mine did, do you have a group of friends who support you during the bad times? That is every day,
yeah. So first of all, my portfolio has dropped by more than 20% in the last year and a half. So 20% is nothing. In 2008, my portfolio dropped by 46%, and so certainly a group of friends is good, and so misery loves company, and it is miserable. I mean, and I don't know, maybe Warren Buffett doesn't feel miserable. I don't enjoy it very much, and even if I do have cash to invest, it's just not a nice feeling to know that the liquidating value of your portfolio is lower. But I think even more important than that is to have your lifestyle set up in such a way that it really doesn't matter, and that's much harder. And actually. Speaking to which, this is so fascinating. As you can see, I have a one-track mind, and my one-track mind right now is thinking about cyclical, pro-cyclical, and counter-cyclical. And, one of the aspects of setting up a fund where you have outside investors is incredibly pro-cyclical, because the only time you can really raise money is when your fund's going up. That's not entirely true, but it's largely true. When the fund's going down is when people want to redeem, which is exactly when you need cash. So, in a certain way, it's structurally bad. It's structurally not ideal. And so I think that more important than friends is to have those relationships. The problem with, even within different kinds of funds. So if you have redemption terms on a 1 week notice, that makes it much more likely that people will take money out at the bad times, exactly when you need that cash to invest. So you can have, if in my fund you have annual redemptions, that's a lot less pro-cyclical than if my fund allowed weekly redemptions or daily redemptions, which would be far more pro-cyclical. But even having said that, 1 year redemptions is still, I would argue, slightly pro-cyclical. So it's those kinds of structural aspects that I think that really, really help. Really, really help. So, and friends is nice, but friends is dangerous, because they can come and go. and they may not think the same as you, and they may lose heart themselves. And so I think that, you have to go to a far more lonely personal place. Good investing is just not a social activity. It's just not. Having said that, I had a nice phone conversation with our compatriot Monish Pabrai today, and and I think that there was a lot of. It felt good to talk to somebody else who's taking a beating.
Thank you.
Yeah, great to meet you.
Hi, guys. In 2007, there was a lot of talk about investing. Like when people in the subway ask you to invest, that was a telltale sign that the market was going to go bust very soon. So, from your experience, are there any other telltale signs that you would watch out for in terms of an exuberance or a peak?
I tell you something. I think that I feel like I know many of the I don't know. Would it be fair to say the best investors? Some really good investors of my generation, and I would tell you that a lot of them are rattled. A lot of them are really uncomfortable. A lot of them don't understand exactly what's going on. And I think that that's probably, it's actually not my thought. It's a thought that originated with this friend William Green. It's actually it's a very bullish signal that even, but you're not entirely sure about that. So I think that one of the hard. Tell me your name.
I'm Aparna.
Malpana. So one of the hard things that I've had to do is that to try and calibrate my peer group. So and my peer group's been changing. I have a bunch of really smart friends, and so they are not necessarily the vast majority of investors. Do I want to be in sync with them, or do I want to be out of sync with them? If my friends are really bullish, does that mean that I should be fearful because they represent the average stock market investor, or does it mean that I actually should be bullish along with them because the rest of the market participants are fearful? So suddenly, when the barber's talking about what stocks he's buying, that's probably a good bearish signal. That's a good signal that when the exuberance has reached that far, and a good bullish signal. I mean, I think that there was I don't remember exactly the time, but it was like there was a time when, and it's not been in my lifetime, when people just said you buy stocks. You never buy stocks; those things never go up. So there are all these things like the story of the Washington Post, which was trading at discount to everything you could measure. And people are like, well, you don't buy the stock. I mean, that's just never going to go up. We're nowhere near that period. We may never get back to that. I think calibrating that, I think you put your hands, calibrating the overall state of whether the market's fearful or greedy, whether the average participant is fearful or greedy, is a fantastic thing to think about. It's just really, really hard to measure, and certainly precisely, but and I would argue now that you don't even have to talk to people. You just have to look at the market action of many of the stocks out there to know that there's more fear than greed. But you still don't entirely know. Maybe that fear is justified. There's a memo that I haven't fully read by Howard Marks that says, what does the market know? Does the market know something? But yeah, I don't have any other great indicators. But I'd put this to you as well. And you will graduate business school, and you're a smart person, and you will get to each one of you in this room. You strive for success. It's why you are where you are. It's why you do the work to be in an institution like you're in, and why many of the people were never able to do the work. And sooner or later, there's going to be a bubble around you. There's going to be, and it may be a personal bubble. It won't be like the world's in a bubble, but people will think that the sun shines out of your rear end, and at some point, you'll start believing it. And even if you don't want to believe it, you'll start believing it. And so, how do you calibrate those kinds of bubbles and those kinds of sort of irrational exuberances? And how do you put in systems that ensure that you don't take them too far when they happen, that you enjoy them, but you don't sort of allow them to get you into trouble? you know, when I have the answer, I'll write another book, but I'm not sure I'm ever going to have the answer. But again, I would just tell you that the fact you're asking the question, you know, it's the question contains the answer. It's a hard question. There's no easy answers, but merely thinking about what the answer might be gets you a lot further down the line than anybody else.
Thank you.
I have my computer here. I've just seen that the flight that I'm now taking out of here leaves 1 hour later. So I got more time for you guys.
We should stick around. Hi, my name's Mano. I've got a couple of questions for you, but they're related and they're about cyclicality, so you'd probably like them. So one is, you talked about how your investors are naturally very pro-cyclical, and they take the money out when you want it and put it in when you don't really need it. So do you do anything to pre-qualify these investors or to prime them to your philosophy? And do you sometimes turn away investors who are not right for you? And the second question is, there's also a lot of pro-cyclicality in public life. So we have people who will never support deficit spending by a government and people who will always support it. And these are both pro-cyclical in some times. So do you see any public policies out there that are genuinely counter-cyclical that one could support?
So you know, just if just going to your second question first, there's in a time of economic decline or of low growth in the economy or a contraction, the taxation base goes down. So the amount of taxation revenues that the government takes in becomes in absolute terms lower, but much of the government spending remains fixed because there are commitments to unemployment benefits and transfer payments of all sorts of different kinds, and so that is a natural stabilizer. That is, so the government takes less money out of the economy through taxation, borrows more in order to fund spending that continues no matter what, and that is counter-cyclical. That is very good. And in spite of the political debate and, you know, people on the right talking about how, you know, the government spending was ridiculous, we've borrowed all this money, but at the end of the day, it happened. And even if a lot of it was misspent, it happened. So I would argue there are some natural stabilizers there. The independence of the central bank is another one. When there was political interference with central banks policy was far more pro-cyclical. And you know, everybody understood, every developed economy has understood that you need an independent central bank where the person setting monetary policy has got some clear targets which are not related to the political cycle. And that's a very, very good thing. When it comes to investors, here's what I've learned is that I literally, in 2008, you know, somebody who had always professed and protested to being a long-term investor suddenly needed to put her hands on cash like instantly, and suddenly all the long-termism disappeared, and there was sort of like short-term need for cash. And you know, it's very hard to test. There are all sorts of reasons for that. Part of it was psychology, but part of it, I think that she was probably overextended. She either had debts that were coming due, or she had a big mortgage, or she'd renovated a house, or I don't know what. There's 1,000 different ways it can happen. And so, you know, I think that interviewing somebody or talking to them or communicating to them is not the most effective way of picking an investor base that is as counter-cyclical as possible. I think you need to sort of set up your shop in such a way that counter-cyclical investors are more likely to show up. And I would tell you that the transition from a zero management fee, 1-year lockup, compensation structure, the transition to that from sort of like a sort of slightly more standard 1 in 20, where people were actually able to take their money out once a quarter. It's not as if, I just think, and it's not a guarantee, but the people who show up for those kind of investment terms tend to be more long term. So I think it's not in the interviewing of people, because people will say something and genuinely believe it, but then the crisis hits and all they want to do is get out of your fund. I don't think that it's So I don't think interviewing them is the right way to do it. I think that structuring it in such a way that only the right people show up. And so what I would likely do in the future with Aquamarine Fund is actually, at some point say, bake in the existing investors, but say any new money is only going to be invested with me if you invest at 5 years at a time. So effectively, it's saying, unless you want to put your money with me for 5 years, and after 5 years you can either take it out or re-up for another 5 years, you're kind of saying, I only want really long-term money, and it's baked into the terms of the contract. I would just add to you that I understand that, this Chinese investor, Li Lu, who has Charlie Munger as his client, Charlie Munger's allowed him to take outside money, but basically they run it like a club. So in order to become a member, you cannot be blackballed by any other member, which is extraordinary. And and I think that I probably would like to institute that in my fund. So I'd start with sort of a committee of people, and I just tell every prospective investor, I'll take your money if you don't get blackballed by any of these people, and you're welcome to meet them. They've allowed themselves to be identified, and that probably does help. I think the less anonymous your fund is, the more it enforces good behavior amongst the investors. And so that probably is a smart thing to do, but it's not the interviewing, it's the kind of the structure that you set up that people know they're becoming a part of.
Thank you very much.
Yeah, great to meet you.
Hey, Guy, thank you for sharing all this with us. So this is a bit more about you, but I was hoping you could share your experience in 2003 when you, along with Bill Ackman and David Einhorn, were kind of the target of an investigation. So from my understanding, it was just that you guys shorted 3 companies, and it just so happened to be a very good call on your part. But I was just hoping to hear what your mindset was behind those shorts, as well as what that process was like.
That's a fantastic question. It's the first time somebody's asked me that question. I could give a whole lecture just on that. So, here's how it starts. It starts with my fascination, and some of this is in the book, but it starts with my fascination with Warren Buffett's investment in Freddie and Fannie. And I had an investment in Freddie, and and I'm now scouring the world for similar kinds of businesses. So I figured out there's no other business anywhere in the world where a private institution that loans against mortgages has an implicit government guarantee. But then I find this company, Farmer Mac. And Farmer Mac does have this implicit guarantee. And so I invite the management, and they come and give a presentation. And I'm super excited. I mean, this looks exactly the same as Freddie and Fannie, except for farm loans. There's a system of farm credit banks which are very good but inefficient, and this is potentially a much more efficient way of doing it. And I'm like, this is awesome. So I was invested in Farmer Mac, and then Whitney Tilson, who's a guy who'd met the management team, he says wow, this looks like a good idea. Let me tell my friend Bill Ackman about this. So Bill Ackman looks at it, and he calls Whitney up the next day. He says, Whitney, that is the best idea you've ever given me. And Whitney says, oh, so you like it? He says, I love it. This is the best short I've ever seen. So Bill Ackman goes and shorts a ton of the stock. And then because he's good friends with Whitney and Whitney's good friends with me, Whitney tells him, look, Bill, you got to let me tell Guy Spier that you're massively short this thing. So he comes and taps me on the shoulder. On a weekly basis, would get together to discuss stocks. And I think he's trying to set me up with somebody because I was single and he likes to do that. And he tells me he's short Freddie Mac, and I'm like, really, and he says, look, try and prove me wrong. I mean, maybe I'm wrong. I don't think so, but try. And I'm like, hey, Bill, you have my attention. Can I keep talking to you? He said, no problem. I'm on my way to my office. So I walked with him all the way from 59th Street down to 42nd Street, all the way into his office. And some of this is described in the book. Anyway, so about 3 weeks later, I organized a meeting with Bill Ackman and the management of the company and Whitney. So Bill Ackman, Whitney, and I take the train down to Washington. We go into the management of the company, and they've got this presentation. And Bill kind of says, 5 minutes in, he says, look, I don't need the presentation. I just have some questions. And he starts asking them questions about their securitizations. And at one point, the CEO of the company says to Bill Ackman, he says, maybe, given the style of your hostile questions, although he didn't say that, but his attitude betrayed that, this might not be the right investment for you. I was just blown away. I'd already sold the stock. I mean, after I talked to Bill Ackman, I realized I didn't know enough. I sold the stock. The management's response to Bill Ackman's questions was so pathetic. And, Bill was asking very, very good questions and very reasonable questions. I decided to short the stock. I think it was the only stock I'd shorted at that point. So I shorted the stock. Then I did something that I wish I hadn't done. So Bill was into the sport of shorting stocks. He had a friend who worked at the New York Times. She was going to write up the CEO of the company, the whole company in a negative way. And I was all excited to feed her with some information. And I was mentioned in that story as being a guy who shorted Freddie Mac. So now the world knew that I'd shorted Freddie Mac, or anybody who looked me up in the New York Times could find that out. So then Bill Ackman later figures out that MBIA is a fantastic short. And there was another one, I think it was Allied Capital and others, that I didn't even short. But when Bill shorted MBIA and he bought CDS credit default swaps on their bonds, he was getting into a fight with a very, very powerful corporation. So MBIA guaranteed, I don't know if they do today, but they guaranteed many of the municipal bonds in the United States, and that gave them an awful lot of power and leverage. And they didn't like the fact that Bill Ackman was shorting them. And at some point, I don't know how much longer afterwards, I get a call from a Wall Street Journal journalist who says, there's this story that you're going to appear in, and I'd just like to check some facts. And, I think he sent me out excerpts of the story, and it basically, parts of the story insinuated that Bill Ackman, Whitney Tilson, and David Einhorn had conspired to manipulate the prices of certain stocks, and that this was very suspect and very bad. And it specifically mentioned Farmer Mac and MBIA, and what it said about my relationship to Bill Ackman, it said, I'd appeared on he was a classmate from business school, he was the year above me at business school, and that I'd appeared on a panel with him. So it created these kind of spurious connections. Now, so this story came out, and then I have Bloomberg and various journalists saying, hey, if this isn't true, why don't you just rebut it? Why don't you speak up for yourself? And I was just cowering in the corner. I was too scared to do anything. Whitney and Bill, and I think David got, the SEC read stories like this, and they got requests for it's an informal request for information from them. Could you just send the emails that you sent between each other? And it took about 3 or 4 weeks or 6 weeks before I get the same email or the same letter. And I had to sit down with lawyers, and I discovered from the lawyers that I'd done absolutely nothing wrong, but that now there was an informal investigation on me, which went nowhere. But it was one of the worst periods of my investing career, but one that I would have handled very differently. I would have liked to have handled differently. So, the SEC letter came, and I had a phone conversation with the SEC. What I wish I had done is just said, SEC, come into my office, take anything you want, interview me for as long as you like. I have nothing to hide. If I've done something wrong, I will make amends. I will pay the fine, or you can even shut me down. I don't believe I have, but I'm an open book. And what I did was, I hired a law firm, and the law firm said, you will not do any such thing. You will have all your dealings with the SEC through us. And, the SEC looked around. There was nothing there was no wrongdoing. and they eventually shut it down. But it just goes to show that simply being mentioned in a newspaper article, and this newspaper article was a scurrilous newspaper article that was written because I believe it was written because somebody at MBIA had leverage over the Wall Street Journal, and they said to the Wall Street Journal, "You need to write this article. We're asking you to do it." And in a certain way, it was my mistake for, if I'd have never been public about the fact that I was shorting Farmer Mac, that probably would have never happened to me. And so, but I also feel like I should have handled the SEC differently. I would have handled the SEC in a far more open way, were I doing that again. But, I can guarantee you that you'll have at least one story like that in your life. Start preparing for it now. And realize that, decide how you want to be, who you want to be, and realize that if you're like me and you want to be, what I want to be is radically open. I want to have the attitude with every single sort of regulatory body that is. First of all, I tell all of my staff, if they ever watch this, if this is being videoed, if they watch it, I say to them time and again, I say, if the SEC or FINMA or any regulatory authority from any developed country, so developed country that we trust, so if it's from the United States or Western Europe or New Zealand or Australia or Canada, or I make a distinction. If it's a call that's coming from ISIS, I do not expect them to take the call or to give any information. Or if it's coming from a corrupt country that I don't trust, Russia, for example, that might be different. But just take the United States. I tell them, you get a call from the SEC, you answer every question. You don't need to get legal advice. You don't have to ask me. Just answer every question honestly. Just give them the answers and make sure that they know that there is nothing interfering with your answers. And that if they want to come, you don't need to get my permission to invite them to the office and to pick up and photocopy any documents they like. That's the way I want to operate. And I've established that so that, law firms know that that's my approach. They can't stop me. That's just the deal with this particular client. And I think that's part of, what we need to do is earn trust back from regulatory bodies, and we have to earn trust back from, the publics that we serve. And I wish that I'd done that in that run-in with the SEC. And what the law firm told me at the time is they said, look, you can take that attitude. It's a very nice, wide-eyed and blue-eyed and sort of naive attitude. But there are some seriously messed up people in these organizations. They have political motives, and they may just shut you down for no good reason. And what I would have liked to have said back to the lawyers is, well, if they shut me down, then that's just fine. There are other things that I can do. I just don't. And I think that, interestingly enough, I just think that you'll get into situations where the lawyers tell you to act a certain way, which is kind of adversarial. And I just think that the world, it's just like that. It's so boring. It's so tedious to be adversarial. Let's solve problems. We understand that you want oversight over our activity. We're going to give you that oversight without forcing you to make legal requests. We'll just give it to you. So I think I'd like to believe that we voluntarily, as participants in the financial industry, can have an ethos, develop an ethos going forwards, which is far more collaboratively open with the regulatory bodies that are seeking to regulate us in the public interest, and we should not see those relationships as adversarial. So there's a potted history.
Thank you very much. Appreciate it.
So you've alluded a little bit to the benefits of moving away from the noise of the street. So I'm wondering if you can talk to some of, I guess, the disadvantages as an investor that you're put from not being on Wall Street.
I tell you, so one thing is, hey, there's a big part of me that just wanted to go and live in continental Europe and be in Zurich. But in a certain way, I mean, a conversation that I had with this person who works with me, Orly Hindi, is that for the first year it was all quiet, and then I brought Wall Street with me. Wall Street came and found me in Zurich because it's a part of my personality that attracted that in. So on some level, moving to Zurich was not, it helped me for a short time, but actually it just masked what the real issue was. And the real issue is not where I live, but what parts of my personality attracting that stuff into my life. And, I'd attract them into my life wherever I lived. And if I was if I had that knowledge now and I'd chosen to stay in New York City, I think I would have realized that I think New York City is a hard place to develop a calm, equanimous attitude to the world, but it's an inner struggle. There's a misprojection there. It's sort of like assuming that it's all the environment. It's not. Much more of it is internal. There's some great investors in New York, but they have a very different set of relationships, and they've managed themselves in a different way than I have. So I don't think that I think that probably, again, this is like the ways in which my book is stuck with my thinking at one particular point in time. I think that perhaps a better way of describing that move before I get into the second part of your question is, where am I the most grounded? Where is the place where I have the biggest number of people who know how I used to be, with whom my relationships go back a long time, where I can really sort of feel like I'm the most true version of myself. It's not about moving to some place designed to bring out certain aspects of our personality. It's like, where can I be grounded? And it may be that New York City is the place to be grounded. The disadvantages, it's funny. I think that I travel a lot to the US, and I learn a lot in the US when I'm here. And I would actually prefer not to travel as much. And I think that maybe if I was not in Zurich and I was maybe somewhere in the US, I would travel less. But for that matter, I don't know, because my family's in London, so I like to travel to London all the time anyway. I would tell you that when I moved to Zurich, I think it was the first iPad had just come out. I mean, I get on my desk every day, a printout of the American Banker. I have up-to-date news. I have a voice over IP telephone that puts me in touch with anybody I want to be in touch with on a local line. I don't think that there are that many disadvantages actually on just a practical level. I look at the same capital IQ Bloomberg that everybody else looks at. I can download the filings the minute they're filed the same way as everybody else. I can participate on conference calls the same way that everybody else can. I don't think that's important. I think the bit that's really important is, where am I most grounded? Where am I? And something else happened for me. This Value X conference that this guy John Miljevic and I run. I mean, we just have great fun with it, and they're great people who come out there, and there's a great group of people in Zurich, and sophisticated people. I mean, there's a guy called Robert Leitz who's, he's got a fund called I Like Partners. He studied at Columbia. He's German originally. He's married to an Indian woman. He's done a lot of work at Glencore. I mean, there are phenomenal people there. It's an incredible meeting place of people from all over the world. I don't think it's a disadvantage, but I think the real key is this idea of being grounded. Go to the place where you're grounded. Everything else will flow from that. Having said that, sorry, because I see you looking at me, feel free to go to New York for a few years. It's a lot of fun, and it's really worthwhile. And look, Warren Buffett did it. It doesn't hurt to be in New York for a few years. I think that there's a sort of a change in one's mind that happens when you go to a place like New York that is just really valuable to experience. So, yeah, thank you.
Hi, Guy. My name is Vish, and nice to meet a fellow Indian.
Got it. Good.
So, I have two questions. One is because of your associations with India, you're a big follower of Gandhi, and you have your friend, and also you're a big contributor for Dakshina Foundation. So what do you think, how do you feel about investing in Indian equities? because I spoke to George about it, and George says he's not really comfortable going to a developing economy. So, and my second question is about the circle of competence, which Warren Buffett talks about. Value investors, as you touched and even George talks about, are very independent. So how do you let other people's circle of competence? How do you take advices from other people's circle of competence? How do you train yourself for that?
Yeah. And you know, in this period, so when markets go down, I think it's another way of describing it is all these investors realizing that their circle of competence was narrower than they really thought it was. And when markets go up, you know, our circles of competence expand and expand and expand. And trying to work out what is your circle of competence, what do I really know? Do I really have an edge here or do I not have an edge? Is just not an easy question to answer. It's so easy to say invest within your circle of competence, but defining what one's circle of competence is and really knowing what it is and developing it, I think, is something that actually I would give a lot of thought to. I mean, you know, you could imagine, you know, business school 10 years out, there'll be like a whole module or maybe even a whole course just on defining your circle of competence, how to recognize when you're at your limits or not. Because it's such an easy concept to describe, but what, you know, I invested in this company, Alaska Milk, which will segue to our second question, in the Philippines. Was that in or outside of my circle of competence? The investment worked out really, really well, so I think I could make a claim it was inside, but maybe it was outside and it was just blind luck, you know? I felt like I had a clear analysis and understanding of why the family that controlled this company was not corrupt and was going to make money for everyone. But maybe that was just dumb luck. I have no idea. On the India front, you know, I just read in the newspaper today that IKEA is having great trouble. Can you believe it? I mean, it just shows the problems that people like Narendra Modi have to deal with. I mean, there's, you know, one of the lowest cost economies on the planet, and IKEA, who are required to source, I think, is 1/3. I mean, it's not an onerous amount. They're required to source 1/3 of their product locally. And they can't find product to fill their stores with locally, so they're having real problems complying with the regulations. And the article talks about how, you know, sort of a flat-packed furniture sourced in India has certain kinds of formaldehyde, which are too high levels for their corporate standards and are potentially dangerous, and that the plates that they want to buy have, I mean, you know, and obviously India will not be like that in 20 years, but there's just, it's an enormously different economy to one like the United States or in Western Europe. And I think that if I were Indian, really Indian, not just pretend for the sake of it, if I spoke Hindi, you know, I think that is a market where it probably is good to be on the ground and to do really, really sort of aggressive scuttlebutt. So, you know, go and meet with them, you know, take 6 months. So there's a guy called Girish Baku who works for Ruane Cunniff, and he does this. He's American, you know, he's Indian, he's American of Indian descent. So he goes to India as kind of an American, but then, you know, he'll spend 6 months meeting with every single bank around the country, and through multiple conversations and multiple studies of the different banks' balance sheets, try and figure out who are the most conservative and well underwritten lenders. And so it's a market where being very, very close on the ground, I think, can probably yield enormous rewards. That is just very, very hard to figure out from just reading the documents at a great distance, which is what I'd be forced to do. That said, you know, I really regret selling my investment in Crizzle, and I'm on, you know, I'm now set up so that I don't have to take too many steps to reinvest in Crizzle, and I probably would at the right moment invest in Crizzle. But the great thing about, you know, finding an investment like Crizzle is there's almost not an Indian investment. It's you're investing alongside S&P, and you get S&P's management and all of those good things. But yeah, if I was, I don't know, look, you know, I would be fascinated, you know, if you could have a parallel life, what would Monish Pabrai do in India, you know? But he chose to live in Southern California, and I can totally understand why. I think that he would have lived a very different life, but probably would have been, who knows, maybe more financially successful. That said, I just think once you've lived in a developed economy like the United States, Canada, Western Europe, it's very hard to want, for me at least, to want to live in an undeveloped economy because it's just so many things, so many things. But I think the opportunity is great if you're willing to live there.
Thank you, Guy.
Good evening, Guy. My question is about what you said was your biggest mistake. Given that investors it's very important for them to have a good attitude and be very confident. I was wondering if you could share with us some of your ideology and your methods that you use when you realize a big loss in order to have the confidence to make your next investment, especially when your money is yours and other people's as well.
It's very hard, I can tell you. I mean, my father looked at me. I was with my father, and he's one of my most important investors. Just in a matter of weeks ago, and he just said, "I don't envy you, Guy. You have a really difficult job." And I think that the worst of that is the feeling that look, I firmly, it's not like I run a portfolio, and Horsehead was a large part of that portfolio, larger than it should have been, and it's a loss in the portfolio. But I have to accept and understand, and my investors have to accept and understand that I will make mistakes. And so that's kind of an inevitable, it's part of it. And it's funny, it's easier to write about than to actually live through it. It's so easy to write about Sir Ernest Shackleton's mistakes that he made. He was like trying to save the lives of his men, and he made mistakes that resulted in his ship sinking in the middle of the Antarctic ice. I don't think there's any answer other than to say yes, it is hard. And I did force myself to buy some stocks a couple of weeks ago. I think they're really good stocks. They'll do really, really well. But yeah, I think it's hard. And the worst was I got some really, I wrote this letter to my investors, which kind of says, hey, this is where we're at. It's not an easy time. This may well be a bullish signal. I've suffered some tremendous losses. I'm learning the lessons. And a lot of investors like, Guy, we're with you. And then there's one guy who sent me a piece of hate mail, which was shocking to me. I mean, I got up from my desk and just walked away. I was it was quite upsetting to me to see that, and made me think that I wish. That moment, I said to myself, if only I just shut down the fund 6 months ago, then I wouldn't have had to deal with this. So I don't know I don't know what the answers are. I mean, I don't think it was easy for me in 2008. I don't think it's easy now either. And who said that life was supposed to be easy? This is not an easy moment for me, that's for sure. And I'd like to pretend that it's all just fine, but it's not easy to see investors rattled. It's not easy to see quotational losses on the stocks that I own. It's not easy to see developments that I have my analysis as to why they're wrong. But right now, the market agrees with the people who want to sell the stocks that I own. And those are the guys who rule the day. And I think they're wrong, and eventually I'll be proven right. But right now, it's not an easy place to be. And I think that, and here's part of why I was talking about the cyclicality is that in an exuberant period, people like Guy Spier become more and more confident about what they're doing. And so I became more concentrated than I would have liked to have been. If my position sizing had been more conservative, I'd be dealing with what's going on in my portfolio. Emotionally, it would be a little less hard to deal with. But, nobody said, in a certain sense, think of what I'm trying to do. It's incredible arrogance. I actually am thinking that you know, the world will allow me to accumulate more than my fair share of claims against society's resources. And I have the arrogance to think that I can successfully do that by reading annual reports, checking out companies, studying stock prices, and placing a few well thought out bets. And even if it proves over the course of an investing lifetime, if that proves to be true, what? It's supposed to happen easily as well without any anguish or pain. I mean, it's really a tall order, and so I think that Charlie Munger said. He said somewhere. He said, "Look, it's not supposed to be easy. If it was easy, everybody would be doing it." And yeah, so it's not easy. But I actually thank you very much for the question, because the question and the opportunity to articulate what I'm saying actually makes it better for me. So I deeply appreciate your question. So, and so I'm sitting there at lunch with this guy. So there's a guy and I think this is all public information. So there's a guy called Daniel Egerter who lives in Switzerland. He in the United States invested into a company called he started a company called Ariba Technologies, which he sold in the dot-com bubble for $5.6 billion, of which he was 20%. So he took like $1 billion out of it. One of the early internet entrepreneurs. And then the way he was written about in the German press, he proceeded to lose half of it. So his market portfolio went from 1.2 billion down to 600 million. And I know that every single person in the room is crying crocodile tears for him because 1.2 billion to 600 million, you're still a very, very wealthy guy. But and I didn't know him at the time, but I'm sure it was extremely painful for him. That's life in the big city. And so I'm complaining to him about my portfolio. And he just says, "Well, Guy, all I can tell you is read your book." Because all the answers are in your book. I'm like, I don't want to read my book. I want comfort. But your question does give me some comfort. And if you guys haven't seen any like Kenneth Branagh goes and plays this guy, Ernest Shackleton, I really do think, I write about it. When you see the mistakes that Ernest Shackleton made, what I'm going through is nothing, really.
Thanks very much.
Actually, I'll just share with you one last point. I see George is going to come up, and this is like perhaps a good point to end on. Is I don't know. Somebody must have said it before me. I don't know who it is, but I'll say it to you, and I believe it is very, very true. Your success in life will be directly proportionate to the amount of uncertainty that you're willing to tolerate. And so in a certain way, I will have greater rewards than somebody who's not willing to tolerate the kind of thing that I'm going through right now. And I'll have lesser rewards than people who are willing to tolerate a lot more. And there's nothing wrong. So I think that, if you agree with that statement, and I think it's just a true statement, the worst thing would be to pick a safe path when you're actually capable of a lot more uncertainty. And, and to realize that uncertainty is not a bad thing and anguish is not a bad thing. It's a part of life. And if you're willing to put yourself in a place where you have that, there are enormous rewards, because many humans are just not willing to do that. And, so I wouldn't necessarily shy away from it. And what I tell you, and this is certainly true, and I feel very strongly about this, the biggest asset that every single person in that room, in the room that you guys are sitting in, is that you have your careers ahead of you. And there is a big difference with how rationally you should behave when you have a lot of years ahead of you to recover from mistakes and to recover from setbacks than when you have a short number of years. And I would argue that when you come out of business school, you should go for high beta, high uncertainty outcomes in the choices that you make, where there's a potentially, I guess I'm just giving you the Dando thing, which is, as long as you don't lose much, as long as you don't get injured, as long as you don't give or get any diseases, as long as you don't do permanent damage to yourself, you want to get into situations where there's enormous uncertainty and enormous upside, and leave the kind of safer bets for later on in life when you don't have as much time to recover from them. Yeah.
Our time is up, so unfortunately I have to cut off some of my students. But I have a last very quick question for you. What is the most important thing in life and investing you learned over the last 10, 20 years?
In investing?
And in life.
And in life. So if there's, I don't think I can put it into one thing, George. It's got to be two. So, trust the Greek philosopher to ask me the difficult question. So. So look, they're maybe they're the same thing, but outside of investing in life, the most important lessons I've learned are from my wife, and it's in the relationship with my wife, and I think that we have a good marriage. I think, but think of the biggest, the most enormous amount of humility that you could possibly muster up, and the biggest amount of forgiveness that you can possibly muster up, and the biggest amount of acceptance of things that you just never think you'd ever want to accept, and then multiply by infinite, and that's kind of what you learn in marriage. And so and just learning how to accept how the marriage shapes me, and learning how to be the person that can make the marriage successful, I think has been at once, in a certain way, one of the most humiliating. It's humiliating because you have to give up so much of your ego. I had to give up so much of who I thought I was. And of course, what I gained is a place in the world, a very real place in the world, because I'm a husband and a father and all of those things. So it took me 10 years out of business school. I graduated age 27. I got married age 37. It took me 10 years to get married. And if I had that time over, I would have wanted to get married sooner. I think that in a certain way, maturity only happens once you're married. And it's good to get going on that sooner rather than later. I also know people who got married at 21, and there's drawbacks to that. But I actually think I got married too late. But then in investing, I think that I have continuously underestimated the need to manage my own psychology. And the realization that it's not just managing my own psychology, it's managing my own psychology through a changing landscape. So, my own psychology 20 years ago, when nobody knows who the hell I am and I can quietly operate out of the bedroom of my apartment, is one thing. And managing my psychology when I've got professors of business like George inviting me to speak is another thing. And how to do that is I think I've gotten better, but I think that I've got so much to learn. So I haven't answered your question, George. So what I've answered is that the lesson that I still have to learn. The lesson that I have learned, this is a slightly trite answer, but look, people think I'm nuts, or people of my ilk are nuts. I pray at the church of Warren Buffett. I really think that Warren Buffett is a kind of a prophet. In the same way that if we'd have lived in Old Testament times, people like Ezekiel would have been a prophet, would have been considered a prophet. So there's somebody coming in, they want to clean the room. And I just think that Warren Buffett is not somebody, he's not just happens to be a successful businessman. He's a guy who's fundamentally changed our own perception of what it means to be a capitalist. He's taken it many steps further, and I think that the world is a better place, and capitalism is something better because Warren Buffett has lived the life that he's led, and of course he's towards the end of it. He's not going to have that many more years with us. And so the lesson that I've learned is that there's nothing that I learn that I don't realize after I've learned it that Warren Buffett already knew. And I think that he just deserves enormous and intense study. There's just so much in that life that can instruct us. And it's so funny for you to invite me to speak to you, because in a certain way we're all seeking the same thing. We're seeking the wisdom of Warren Buffett and Charlie Munger. So maybe that's the lesson. And as you can see, I'm a work in progress. There's a lot more improving that I can do.